Hello! Today we're going to be discussing the straight line method for creating an amortization table for bonds. The question says, on January 1st, 2011, Chewy's Pet Grooming issued $500,000 of 10% 2-year bonds. The bonds pay interest semi-annually on June 30 and December 31st. The market rate of interest on the date of issuance was 12%. The bonds were sold at a price of $482,678. We're asked in Part 1 to prepare an amortization table using the straight line method for these bonds, which we're going to do in this chart I've created here. So the first thing to note is that these bonds are going to last for 2 years and they pay interest semi-annually, so that's twice a year. So that's going to make for 4 interest payments, which is going to be these 4 rows that we have here. Now we also have a row for the issuance, which is going to be useful to have a starting balance for our discount and the carrying value. So let's first start with the balance of the discount. The discount starts at, well, the par value minus the selling price. So if we take the par value of $500,000 and we subtract the selling price, which is $482,678, we get a starting discount of $17,322. To find the starting carrying value, well, that's easy. It's just going to be the same thing as the price. No calculation needed. So that's $482,678. Next, let's calculate the interest payment. That's going to serve as our interest paid column. The way we calculate this is by taking the par value, which is $500,000, and then multiplying by the contract rate divided by 2. So that's by 10% divided by 2. So when we multiply those together, we get $25,000. And that's going to be our interest paid for each of the 4 payments. So now let's move on to the remaining columns of this amortization table. First, the interest expense. Now you might be wondering, why should the interest expense be any different than the interest paid? And that's a really good question, which we're going to explore right now. So this is a graphic that I used when we calculated the price in a previous video. So you'll see we have the sale of the bond, which got the company $482,678. They have the 4 interest payments of $25,000, and then also a principal payment of the par value of $500,000. So I think of the interest expense coming from 2 different places. 1 from the 4 different interest payments, and 2 from the difference from the selling price and the par value. So the selling price is $482,678. You can think of this as the amount that the company is borrowing, but they actually have to pay back more than what they borrowed. They have to pay back $500,000. So the additional amount that they have to pay back is the discount of $17,322, which is an additional form of interest expense. So we have interest expense from the payments and then also interest from the discount. And what we're going to do when we use the straight line method is we're going to divide this $17,322 equally amongst the 4 interest payments. And that's how we're going to record that additional interest expense. So we can go back to our amortization table. And remember, we have 4 different interest payments. And the way you can calculate that is by taking the number of years, in this case we had 2 years, and multiplying it by 2, since they are semi-annual bonds. So what we can do for our discount amortization is we can take the balance of the discount, and then we can divide that by 4, the number of interest payments. And that tells us that the discount is changing by $4,330.50 for each period. So we can copy that down to the remaining 3 rows. And then, as I was saying earlier, the interest expense is made up of the interest payment and the discount amortization. So we can add those 2 together, and that will give us the interest expense. And that's going to be the same thing for the remaining 3 rows. Next, we can find the balance of the discount by taking the previous value and subtracting the discount amortization. And we can continue to do that for the remaining 3 rows. Take the previous balance and subtract the discount amortization. And once you get down to the bottom, you should have a balance of $0. Now for the carrying value, you can do a similar thing. You can take the previous balance and you can add the discount amortization. And you can do that all the way down, and you should get a balance of $500,000. So let's talk a little bit about what some of these values in the table mean. So the interest paid is pretty self-explanatory. The company is paying $25,000 in interest each period. Now the interest expense, we said earlier, is coming from 2 different places. 1, the interest that was paid, and 2, from the discount amortization. So when you add those 2 together, you get the total interest expense. Now, discount amortization is really just measuring how much this discount balance is decreasing by each period. So we started with 17,322, and we subtracted this number to get 12,992, and we continue to subtract it. So we have a decreasing balance of the discount each period until we get to 0 at the end of the bond's life. Now the carrying value, I always had you calculate that by just taking the previous value and adding the discount. But there's another way you could find that, and that would be by taking the par value of 500,000 and subtracting the balance of the discount. And this one always has to get up to 500,000 at the end of the bond's life. Now I just want to note here, if you were to have a premium on the bonds, then this number would actually have to be decreasing. So it would start maybe at 520,000, and then you'd be subtracting the premium amortization in that case. So there's one more thing that I want to do, and that is part 2 right here, which says record the journal entry for the second interest payment. So the second interest payment is 12/31/2011, and I have some journal paper right over here, and that's why we have the date 12/31/2011. And all you really need is the first 3 columns of the amortization table. So let's first start with the interest expense. Interest expense is an expense account, so therefore we're going to have to debit that in our journal entry. So let's debit interest expense, and that is for $29,330.50. Next, we know that we have interest paid of $25,000. Now if that's paid, that's going to have to be cash. So we're going to have to credit cash for $25,000 to decrease that account. And then finally we have the discount amortization, which is $4,330.50. And that's going to have to go on the credit side to balance out this journal entry. And that's the account discount on bonds payable. Now one thing you might be noticing here is that it didn't really matter which row we looked at in the table, because these first 3 columns are the same thing for every row. And you would be right, so it didn't really matter that this was the second interest payment. Now that will change if you are using the effective interest rate method. So these numbers could be different, but if you're doing the straight line method, every interest expense journal entry is going to look the same.